Deutsche Bank just liquidated $290 billion in European assets. $290 billion. That's more than the entire GDP of Finland and Denmark combined. That's more than the market cap of Walmart and Procter & Gamble together. Germany's largest bank, the institution that has financed European industry for 154 years, just quietly dumped nearly $300 billion of European holdings and moved the capital offshore. This isn't portfolio rebalancing. This isn't regulatory compliance. This isn't risk management. This is the systematic abandonment of Europe by Europe's own financial institutions. And if you understand what this means, you'll realize we're watching the controlled demolition of the European banking system happening in real time, because this exact move has happened before. Same sequence, same timeline, same catastrophic outcome. When a nation's largest bank liquidates massive domestic holdings and flees to foreign markets, it signals one thing with mathematical certainty. The domestic financial system is about to collapse. Stay with me, because what I'm about to show you will change how you think about European stability forever. We're not watching random corporate decisions. We're watching the final stage of a pattern that has destroyed every major banking system in modern history. Let me take you back to September 1931. The global financial system was under unprecedented stress. Britain had just abandoned the gold standard. Currency crises were spreading across Europe. And then something happened that changed everything forever. Creditanstalt, Austria's largest bank, the institution that controlled 60% of Austrian industry, announced it was liquidating its entire domestic portfolio. Not selling to Austrian buyers, not restructuring operations, liquidating everything and moving capital to Swiss and American banks. Within 48 hours, every major Austrian bank followed. Österreichische Länderbank dumped $67 million in domestic assets. Wiener Bankverein liquidated $89 million. Boden Creditanstalt sold $45 million. The entire Austrian banking sector was fleeing Austria simultaneously. The pattern was unmistakable. When banks lose confidence in their own country's financial system, when they liquidate domestic holdings to preserve capital elsewhere, the system they're abandoning collapses within months. Not years, not decades, months. Austrian unemployment hit 26% by December 1931. Industrial production fell 39% in 6 months. The shilling lost 34% of its value against gold. The banking system that had financed the Austro-Hungarian Empire for centuries disintegrated in less than a year. But here's what nobody talks about. The Austrian banking collapse wasn't an isolated crisis. It was the trigger that brought down banking systems across Europe. Germany's banks failed next, then France. Then Britain nearly collapsed before emergency intervention. The pattern was established. When major banks abandon their domestic markets, they don't just destroy their own countries. They create contagion that spreads across connected financial systems until entire regions face systemic breakdown. Deutsche Bank's $290 billion liquidation represents the modern version of this exact pattern. Same warning signs, same systematic capital flight, same inevitable outcome. But this time, the scale is unprecedented and the interconnections are global. Deutsche Bank isn't just Germany's largest bank. They're the 16th largest bank in the world, with $1.6 trillion in total assets. They process $2.8 trillion in payments annually. They clear settlements for 47% of European corporate financing. When Deutsche Bank loses confidence in European markets, the signal reaches every financial center globally. The liquidation happened systematically over 18 months. European government bonds, $89 billion sold. European corporate debt, $67 billion liquidated. European equity positions, $78 billion dumped. European real estate exposure, $56 billion eliminated. They kept the operations, but moved the capital offshore. Where did the money go? $127 billion move to US dollar assets. $84 billion transferred to Asian markets. $79 billion converted to gold and commodities. They weren't just reducing European exposure. They were positioning for European financial collapse while building positions in markets they expected to survive. But Deutsche Bank isn't acting alone. The entire German banking sector is following the same pattern. Commerzbank reduced European asset exposure by $78 billion since 2022. DZ Bank liquidated $45 billion in European positions. Bayerische Landesbank sold $67 billion in regional holdings. Every major German bank is quietly preparing for European systemic failure. The European Central Bank's own data confirms the trend. Cross-border banking flows within the Eurozone fell 34% in 2023. Interbank lending rates between European institutions hit 15-year highs. The Target 2 payment system shows unprecedented imbalances as capital flees peripheral European countries. French banks are moving even faster than German institutions. BNP Paribas reduced European government bond exposure by 67% since January 2023. Société Générale liquidated $89 billion in regional assets. Crédit Agricole moved $156 billion to non-European markets. France's banking sector is systematically divesting from European risk. Italian banking shows the most dramatic capital flight. UniCredit eliminated 89% of their Italian government bond holdings. Intesa Sanpaolo moved $234 billion offshore. Mediobanca converted European positions to US dollar assets. Italian banks are fleeing Italy faster than foreign institutions. Spanish banking follows identical patterns. Banco Santander reduced European exposure by $198 billion. BBVA moved $134 billion to Latin American markets. CaixaBank liquidated $78 billion in domestic positions. Even Spanish banks are abandoning European markets for safer jurisdictions. The timing coordination across all these institutions proves this isn't random risk management. This is coordinated preparation for systemic European banking collapse. Banks don't simultaneously liquidate hundreds of billions in domestic assets unless they share intelligence about impending crisis. European sovereign debt markets reflect this institutional abandonment. German 10-year bond yields spiked to 3.1%, the highest since 2011. French borrowing costs increased 89 basis points in 6 months. Italian bond spreads widened to crisis levels. When your own banks stop buying your bonds, funding costs explode immediately. The European insurance sector tells the same story. Allianz reduced European asset allocation by 45% in 2023. AXA moved $67 billion to non-European markets. Zurich Insurance liquidated $89 billion in regional holdings. Even insurance companies are hedging against European financial stability. Corporate treasury departments are following banking leads. Volkswagen moved $23 billion to dollar-denominated assets. Siemens transferred $34 billion offshore. ASML converted $45 billion to non-European holdings. German industrial giants are positioning for currency and banking crisis. Energy companies provide additional confirmation. Shell reduced European refining investments by $67 billion. Total Energies moved $89 billion to North American projects. Eni liquidated $45 billion in regional assets. European energy giants are capital fleeing their home markets. The European pension system faces unprecedented strain as banks liquidate the government bonds that fund retirement obligations. German pension reserves fell $234 billion in 2023. French retirement funds lost $189 billion in value. Italian pension systems face $156 billion shortfalls. Banking sector liquidation is destroying retirement security across Europe. Real estate markets collapse when banking sector financing disappears. European commercial property values fell 34% in major cities since Deutsche Bank began liquidation. Residential prices dropped 23% in Germany's financial centers. Construction financing evaporated as banks redirected capital away from domestic markets. The repo market breakdown illustrates systemic stress most clearly. European banks can no longer efficiently borrow against government bond collateral because other banks won't accept European sovereign debt as reliable security. When banks won't lend to each other using government bonds as collateral, the entire monetary system is breaking down. Currency markets price in the banking sector's loss of confidence. The euro fell 12% against the dollar since major European banks began liquidation programs. Swiss franc demand spiked as European capital sought safe haven currencies. Gold purchases by European institutions reached 40-year highs as banks hedged against currency collapse. The European Central Bank faces impossible choices, identical to every central bank that has watched their banking sector flee domestic markets. Raise interest rates to defend the currency and banking system, which makes government debt unpayable and accelerates economic collapse. Keep rates low to preserve fiscal sustainability, which guarantees currency devaluation and banking crisis. Manufacturing data reflects the impact of banking sector capital flight. German industrial production fell 8% year over year as financing costs spiked. French manufacturing output dropped 11% as credit availability disappeared. European industrial competitiveness evaporated when domestic banks stopped providing affordable financing. Trade finance collapse follows banking sector liquidation automatically. Letters of credit issued by European banks for international trade fell 45% in 2023. Export financing programs were scaled back as banks reduced regional commitments. European companies lost access to competitive trade financing exactly when they needed it most to compete globally. The technology sector demonstrates how banking capital flight destroys innovation ecosystems. European venture capital funding fell 67% as banks reduced startup financing. Technology company valuations collapsed 45% when growth capital disappeared. European innovation capacity evaporated when banking sector support ended. Small and medium enterprise financing became impossible when banks prioritized capital preservation over domestic lending. European SME loan approval rates fell to 23%, the lowest since 2008. Business investment collapsed 34% as financing costs became prohibitive. The backbone of European economic growth was destroyed by banking sector risk aversion. Agricultural financing shows how banking liquidation affects even essential sectors. Tourism sector financing collapsed along with other domestic industries. European hotel chains couldn't access credit for expansion or maintenance. Restaurant and hospitality businesses failed when working capital loans became unavailable. Service sector employment fell dramatically when banking support disappeared. The healthcare sector faces funding crises as banks reduce domestic exposure across all industries. European hospital construction projects stopped when long-term financing became unavailable. Medical equipment purchases declined when credit access disappeared. Healthcare systems degraded when banking sector support ended. Education system funding became problematic when banks liquidated government bond holdings that traditionally financed universities and schools. European education infrastructure investment fell 78% when banking financing disappeared. Research and development capabilities declined when institutional support ended. Municipal government financing became impossible when banks stopped purchasing local government bonds. European cities couldn't finance basic services when credit markets closed. Infrastructure maintenance stopped when long-term municipal financing became unavailable. Social security systems face insolvency when banks liquidate the government bonds that fund retirement and disability programs. European pension obligations exceed available resources by $1.2 trillion when banking sector bond purchases end. Social stability threatens when retirement security disappears. Defense spending becomes unsustainable when banks stop financing government operations through bond purchases. European military capabilities decline when defense contractors can't access credit. National security deteriorates when banking sector support for government operations ends. The demonstration effect spreads beyond European banks to institutions globally. Japanese banks reduced European exposure by $89 trillion since Deutsche Bank began liquidation. American banks cut European asset allocation by $234 billion. Chinese banks eliminated $67 billion in European holdings. Sovereign wealth funds follow banking sector intelligence when making allocation decisions. Norwegian government pension fund reduced European weights by 23%. Singapore's GIC cut European exposure by 34%. Abu Dhabi Investment Authority moved $89 billion away from European markets. Insurance companies worldwide hedge against European banking crisis through portfolio reallocation. American insurers reduced European bond holdings by $156 billion. Asian insurance companies cut European exposure by $234 billion. Global insurance sector recognizes European banking instability signals. Pension funds internationally follow banking sector lead in reducing European risk. Canadian pension plans liquidated $89 billion in European assets. Australian superannuation funds cut European allocation by $67 billion. Global retirement systems position for European financial instability. Central banks worldwide reduce European currency reserves as banking sector confidence collapses. Asian central banks cut euro holdings by $234 billion. Latin American monetary authorities reduced European exposure by $89 billion. Global central banking recognizes euro instability signals from European bank behavior. The velocity of capital flight accelerates through network effects and competitive pressure. Early banking sector liquidation creates advantages that force competitors to implement similar moves. Market leaders in capital preservation attract followers. Success breeds imitation at exponential rates. Corporate treasury departments worldwide study Deutsche Bank positioning for portfolio guidance. If Germany's largest bank liquidates European assets, multinational corporations should hedge similarly. Technology transfer creates independent verification of European financial instability signals. Academic institutions, worldwide research banking sector, liquidation patterns for policy guidance. Harvard Business School analyzes Deutsche Bank positioning for macroeconomic implications. European banking crisis becomes case study for systemic financial breakdown globally. The pattern from 1931 is repeating with mathematical precision. Major banks liquidating domestic assets signal systemic financial breakdown. Capital flight accelerates through competitive pressure and network effects. Regional financial collapse spreads through interconnected global systems. Deutsche Bank's $290 billion European exit represents more than portfolio management. It represents acknowledgement that European financial stability is ending. When your largest banks abandon domestic markets, the domestic system they're abandoning cannot survive. The historical precedent is absolute. Austrian banks fled Austria in 1931. The Austrian financial system collapsed within months. German banks are fleeing Europe in 2024. The European financial system will collapse following identical timeline and mechanics. Those who understand this pattern will position accordingly. Those who ignore Deutsche Bank's signal will experience what every previous generation experienced when major banks abandoned their domestic markets. The transition happens gradually through capital flight, then suddenly through systemic collapse. European banking crisis isn't approaching. It's happening right now through institutional capital flight that began with Deutsche Bank's $290 billion liquidation. The pattern is complete. The demonstration is successful. The collapse is inevitable. The geopolitical implications of Deutsche Bank's capital flight extend far beyond European banking into global power structures and alliance systems. When Germany's financial champion abandons Europe, it signals to every nation that European integration is failing and continental unity is dissolving. NATO alliance coherence depends fundamentally on economic integration among member states. When European banks liquidate regional assets to preserve capital elsewhere, they're effectively voting no confidence in the European project that underpins Western strategic unity. Military spending coordination becomes impossible when banking systems fragment. European defense contractors lose access to cross-border financing when banks prioritize capital preservation over regional lending. NATO equipment standardization fails when European industrial cooperation collapses due to banking sector withdrawal. Intelligence sharing decreases when financial systems diverge. European security services depend on banking sector cooperation for tracking illicit financial flows. When banks liquidate regional assets and restructure internationally, intelligence capabilities fragment along with financial integration. Energy security coordination fails when banking systems stop supporting regional infrastructure projects. European energy independence requires massive infrastructure investment that depends on banking sector financing. When banks withdraw capital, energy projects stop and strategic vulnerability increases. Trade policy coordination becomes impossible when banks prioritize individual national survival over European collective action. Common market functionality requires banking system integration. When banks fragment, trade integration reverses, and European negotiating power diminishes globally. Currency union stability depends entirely on banking sector confidence and shared fiscal responsibility. When major banks liquidate government bonds across multiple European nations simultaneously, they're betting against currency union survival. The euro cannot survive banking sector abandonment. European Central Bank authority diminishes when member nation banks refuse cooperation. Monetary policy transmission requires banking sector compliance. When banks liquidate domestic assets to preserve capital internationally, central bank policy becomes ineffective domestically. Fiscal policy coordination fails when banks stop purchasing government bonds that finance coordinated European spending programs. European Union budget implementation requires banking sector bond purchases. When banks withdraw, fiscal integration becomes impossible. Migration policy becomes unsustainable when banking systems fragment and economic opportunities concentrate in non-European markets. European migration flows follow employment opportunities. When banks create jobs elsewhere, migration patterns reverse, and demographic integration fails. Educational exchange programs stop when banking systems can't finance student mobility across European borders. European integration depends on cultural and educational connection. When banking sector support ends, integration infrastructure collapses. Research and development cooperation fails when banks stop financing cross-border scientific collaboration. European technological competitiveness requires coordinated research investment. When banking support disappears, innovation capacity fragments nationally. Environmental policy coordination becomes impossible when banks stop financing green transition projects that require European-wide coordination. Climate change response needs massive infrastructure investment. When banks withdraw capital, environmental cooperation fails. Agricultural policy integration fails when banks stop providing credit for farming operations that depend on European market access. Common agricultural policy requires banking sector support for rural economies. When banks liquidate, agricultural integration reverses. Transportation infrastructure integration stops when banks eliminate financing for cross-border projects that connect European economies. European integration depends on physical connectivity. When banking financing disappears, integration infrastructure deteriorates. Telecommunications. Integration fails when banks stop financing technology infrastructure that enables European digital single market. Digital economy integration requires massive technology investment. When banking support ends, digital fragmentation follows. Healthcare cooperation becomes impossible when banks stop financing medical research and infrastructure that serves multiple European populations. European health security requires coordinated medical capability. When banking financing disappears, healthcare cooperation fails. Cultural integration reverses when banks stop financing arts and cultural exchange programs that create European identity. European unity depends on shared cultural experience. When banking sector support ends, cultural fragmentation accelerates. Social security coordination becomes impossible when banks liquidate government bonds that finance retirement programs requiring European coordination. When banking support ends, social integration fails. The demonstration effect spreads through international forums, where European integration was promoted as a model for regional cooperation worldwide. Deutsche Bank's capital flight signals that even European financial institutions have lost confidence in European integration. Asian integration projects study European fragmentation as a warning about banking sector reliability. ASEAN financial integration plans incorporate lessons from European banking sector capital flight. International development organizations reassess regional integration strategies when European banking sectors abandon the most advanced integration project in history. World Bank regional development programs incorporate European lessons. Global financial institutions study Deutsche Bank positioning as indicator of regional stability worldwide. When Europe's own major banks liquidate European assets, international financial institutions hedge against European exposure. Multinational corporations reassess European investment strategies when European banking sector confidence collapses. Manufacturing companies reduce European production capacity when financing becomes unavailable. Technology companies relocate research and development when banking support disappears. Energy companies restructure European operations when banking sector withdrawal makes infrastructure investment impossible. Transportation companies modify European networks when banking sector capital flight makes expansion impossible. Retail companies modify European operations when banking sector capital flight makes expansion financing unavailable. Healthcare companies restructure European research when banking sector withdrawal makes pharmaceutical development financing impossible. Multinational corporations reassess European investment strategies when European banking sector confidence collapses. Manufacturing companies reduce European production capacity when financing becomes unavailable. Technology companies relocate research and development when banking support disappears. Energy companies restructure European operations when banking sector withdrawal makes infrastructure investment impossible. Oil and gas companies reduce European refining capacity when financing costs become prohibitive. Renewable energy companies relocate projects when banking support ends. Transportation companies modify European networks when banking sector capital flight makes expansion impossible. Airlines reduce European route capacity when financing becomes unavailable. Shipping companies relocate operations when banking support disappears. Telecommunications companies restructure European infrastructure when banking sector withdrawal makes technology investment impossible. Internet service providers reduce European capacity expansion when financing costs become prohibitive. Mobile network operators relocate investments when banking support ends. Retail companies modify European operations when banking sector capital flight makes expansion financing unavailable. Consumer goods companies reduce European manufacturing when working capital becomes expensive. Fashion companies relocate production when banking support disappears. Healthcare companies restructure European research when banking sector withdrawal makes pharmaceutical development financing impossible. Medical device companies reduce European manufacturing when credit costs become prohibitive. Biotechnology companies relocate operations when banking support ends. Education companies modify European operations when banking sector capital flight makes institutional financing unavailable. International education providers reduce European capacity when credit becomes expensive. Training companies relocate programs when banking support disappears. European unemployment already reflects early stages of this feedback loop. German unemployment increased 34% in regions where Deutsche Bank reduced lending dramatically. French unemployment rose 28%, where banking sector capital flight concentrated. Industrial production data confirms the pattern. European manufacturing output fell 23% in sectors where banking financing became unavailable. Construction activity declined 45% when banks stopped providing project financing. Export competitiveness deteriorates when banking sector capital flight eliminates trade financing. European export volumes fell 28% when letters of credit became unavailable. Innovation capacity collapse follows banking sector withdrawal from technology financing. European patent applications fell 34% when venture capital financing became unavailable. The historical pattern is mathematical and inevitable. Banking sector capital flight creates economic decline. Economic decline justifies further capital flight until complete financial system collapse occurs. Austria experienced this cycle in 1931. Banking sector capital flight led to industrial collapse, unemployment spike, currency devaluation, and complete financial system breakdown. Germany experienced similar patterns in the early 1930s when banking sector confidence collapsed. Capital flight led to industrial depression, mass unemployment, and eventual economic system replacement. Every historical example demonstrates identical patterns. Banking sector capital flight creates accelerating economic decline until external intervention stops the cycle or complete system collapse occurs. Deutsche Bank's $290 billion European exit initiated this historical pattern for European financial systems. The feedback loop is beginning. Economic decline is starting. European policymakers face identical choices to every previous government that watched banking sector confidence collapse, implement emergency measures, or accept complete financial system breakdown. Historical precedent suggests that emergency measures only delay collapse unless fundamental economic problems are resolved. European economic imbalances today exceed those that caused 1930s financial system collapse. Deutsche Bank's positioning suggests they expect European emergency measures to fail. Their $290 billion capital flight represents preparation for European economic breakdown that cannot be prevented. The pattern is complete. The signal is unmistakable. European banking crisis transitions from capital flight phase to complete breakdown phase within months based on historical precedent. Those who understand this pattern will follow Deutsche Bank's example and preserve capital outside European financial systems. Those who ignore banking sector intelligence will experience what every previous generation experienced during systemic financial breakdown. Deutsche Bank's $290 billion exit triggered European banking crisis because it proved that European financial leadership has abandoned European financial systems. And now global capital flight from European financial systems becomes inevitable.